I've done my MBA in banking and finance and recently completed my MPhil in management. In the slides, you can see my work experiences with different industry for many of years, but currently I'm working with a KDA organization as a TCM, and along with that, a freelancer at Learnovit. So it's a great privilege to be connected virtually and interact with every one of you with the help of Learnovit. Thank you, Learnovit. So, guys, today's topic is about in the finance session is about shares and debentures, which are a very basic knowledge about like how shares and debentures they are playing role in the financial market, how they are issued, what are different types of shares and debentures. So it's completely about the financial market dilemmas. In the session, we'll be seeing what is financial market and what are they. And in that, we'll be seeing shares and share capital, different types of shares, advantages and disadvantages of shares, how shares are issued, the meaning of debenture, different types of debentures, advantages, and what is the basic difference between shares and debentures. We'll be seeing in that. So let's begin it. We all know that a financial market, you can say a business house cannot be companies or business houses cannot be run until unless they have sufficient amount of capital in there with them, and sometimes capital might be cash in hand or some of the assets, but when there's a amount which is lacking to collect, that those are collected by issuing of the shares and debentures. So the companies they basically, whether that is private or public, they collect much amount of capital required for their organization to run, for the business to run, either in a way of increasing productivity or even getting married up with another companies. They try to get in a diversified forms of collecting the funds by entering into the financial market. And in the financial market, if the company is very new, which is like going to the financial market in order to collect some of the share capital from the capital funds, so they basically start with the IPO. And if they have already gone for the IPO, then they go for FPO. And if these two are they have already basically opened, they go for different types of share assessment inside the companies and inside the and outside the companies by entering into the financial market. Those can be short term or long term, and even in a middle term also sometimes they are dealt. And in such way, what happens is different investors they get attracted. Even retail customers, you can say customers of sales, okay, they can also be getting collected. Then financial institutions they get marred up with that, and then some of the government companies or government banks they try to invest in those companies which are coming up with the new advancement in the business, and they provide the funds by purchasing shares or the debentures of certain companies. So this is basically in a way of high amount of interest. You know that in a business nothing is free. There is given and taken policy still which might be visible in a way, but what happens if a government or banks, say some private companies, financial institutions, or retail governments, or people who buy the shares, they expect in return something, and that is a interest which they expect in that, and that has to be in a very higher range of way. Then only the financial market tries to get up with the company. So if you say what is shares, and this is you can say that one of the equal part into which a company capital is divided, entitling the holder to a propagation of the profits. It is divided into a number of individual units of fixed amount. What is like if you say someone says sales, suppose you are in a way of starting up your business and you are lacking with certain amount of the capitals, you can issue shares, and in that shares might be 50 people, 20 people, or 10 people, they might be interested to buy the shares, means they are investing money in your company in a way of a share, collecting the shares, in which they want individual amounts of interest, or might be a chances of sharing profit also if the share purchase is higher. So shares are basically can be inside the company, can be with the different investors, and when those are with the investors, this directly or indirectly becomes with the company holders itself. So shares are the first basic step of collecting the capital fund which is insufficient in the company, or in a way if a company is trying to get an expansion, then also these shares helps them out to collect the monies. So what is share capital? If it says the fund which is collected by issuing the shares or selling of the shares, those are called as share capitals, and it is like in a form of different things. It can be authorized, registered, or nominal, issued capital, subscribed capital, called up capital, paid up capital, and reserved capital. These are the different names of the share capital in which the fund is being collected. You can say the cash are collected by sharing out the shares. I hope till here clear to everyone. Okay. Basically, if we go with the financial market, no, there are two types of shares which are mostly issued by companies of financial market in on behalf of certain companies, and those are equity shares and preference shares. What are equity shares? Equity shares are like the shareholders of these shares are the real owners of the company. They have a voting right in the meetings of holders of the company, and they have a control over the working of the company. Means equity shareholders are paid individual and dividable amount of paying in the preference shareholders. So certain amount is given to equity shareholders. They act, they just don't act, they are actual becomes out to be turns out to be a real owner of the companies, because they can vote, they can take part in their meetings, board meetings, they can turn out to be a board of members, and even they can buy or sell the shares, and they play the major role in taking the decision on behalf of the company itself. So equity shareholders are, you can say, are, are a way of telling them out to the real owners of the company. What are the preference shares? Preference shares are, you can say, commonly referred to a preferred stock of the shares of the company, which you can say they only get common stock of the dividend policy. And then what happens if the company enters out to be in any of the crisis, the first preference of the company has to pay the amount on which they have taken shares, and the interest has to be given goes to the preference shares, because they are the first preference for the companies. They have invested, they have bought the shares, they have given the cash of their hard earned money. So at that time the first preference becomes out to be the preference shareholders. After preference shareholders are given, then only comes for the equity shares, because preference shareholders do not take part in any of the meetings. They are not, they do not act as the owner of the company, they do not take part in any of the decisions of the company. So preference shareholders are treated like that. Now there are different types of equity shares, and that can be like, you can say, commonly they say it, but the most important three equity shares are right share, bonus share, and sweat equity shares. There can be many more, like blue chip shares, income share, growth shares, cyclical shares, defensive shares, speculative shares. But when financial market deals, they mostly categorize in three forms, and they are right shares, bonus shares, sweat equity shares. So if it is right shares, means these are the shares issued to the existing shareholder of a company. Such kind of shares is issued to protect the ownership right of the investor. Bonus share are given to the company shareholders as a dividend. Bonus shares are always as a dividend to the shareholders. And sweat equity shares are like exceptional employees or directors of the company for their exceptional job in terms of providing know-how or intellectual property rights of the company. So sweat equity share means if in a company, if any of the employee, a certain uh, group of employees or team is doing good, instead of giving them of cash bonus, you give them the shares which they can turn out in the cash anytime when they require. This means it's on the way of their intellectual and know-how way. So these are sweat equity shares, and in the shares, no, it's always a fixed amount, or but in the shares it's fixed amount of interest, but it even gets categorized. If it is preference shares, it's fixed. If it is equity, might be on a basis of profit, might be on a basis of uh, annual income or losses or anything like that. They get fluctuated, but in preference shares, once it's promised that it will be 10%, means it has to be 10%. And if you go with the of preference shares, they are different. They are like only sharing out the dividend, say, to the preference shares, or dividends are shared in a percentage, that is dividends preference shares. If it is in a way of profit, proportion of profits, so instead of giving them interest, they share certain portion of the profit with the organization. And if it is redemptions, means um, amount which can get added up if it is combined with dividend and proportion of income or profits, then com- complementary or comfortability ones, then those share are majorly not be counted. But if we understand, it has to be in a preference share, dividend, redemptions, and participations in profit. Till here, any confusion, guys? Abhijit, any confusion?
Ma'am, actually, ma'am, indirectly it means, ma'am, preference shareholders will have not direct contact with the management of the company.
Yes, exactly. Because they do not take part in any sort of board meetings or any sort of the decisions of the company, preference shares. They just have to mind their way out how much they are getting when they are investing certain, or they are buying the share, preference shares, how much interest they are getting, how much dividend they are getting, what portion of it promised by the company with them in a way of profit sharing. That's
Ma'am,
all.
are they customers?
uh, if you see in a basic business one, you can think about that, but actually they are also a part of company without playing a direct role in the company.
Ma'am,
Clear?
ma'am, please repeat.
You can say that if you think in a basic business way, you can think them as a customer, right? Because they are giving their hard earned money to you for your business expansion, or you're running out your business in a form of by collecting certain certificates of sales with you. Those are preference sales.
Okay, okay.
And if you see it in a financial way, they are a part of your organization who do not directly get involved with you, but they are also a supporting backbone for your organization, means their finance is supporting to you. Clear?
Ma'am, but ma'am, whose share generally will be higher? Equity shareholders'
Obviously
share will
equity
be higher.
shareholders. Equity
Okay, okay.
shareholders. Now advantages of equity shares and both advantage and disadvantage. If you have our equity shareholders, see, if the advantage high return, easily you can transfer, this can be easily liquidated, you have a right to vote in the organization, you can even play a role of choosing board of directors. Equity shareholders have the right to oppose any of the decision taken by the board of directors. And what is the disadvantage? Obviously higher risk, because over here, if you are becoming a part of profit sharing, you have to become a part of loss sharing also. In worst cases, less privilege is given to equity shareholders. Like in a way, if you understand, then suppose if a company gets bankrupt, first priority of the company goes to preference shareholders to give them their money back, and then comes with the equity shares. Now, so equity shares do have many advantages, but there are two disadvantages. There are high risk and less privilege. Now, what are the preference shareholders' advantages and disadvantages? If you see preference shareholders, dividend at a fixed rate or a fixed amount is preferred before any dividend on equity shares. Suppose a preference shareholder is promised to be given 12%. If a company gets 500% of profit also, preference shareholders are only going to get 10% or 12% what is promised. But in equity share, if company is in higher range, obviously equity shareholders has to get the higher amount. So it says that it fluctuations in equity shares percentage can be different, but in preference share it won't be. Return of preference share capital before the return of equity share capital at the time of winding of the company. Is hybrid instrument having some of the characteristics of debenture and equity shares. Now, what are the disadvantages? They do not provide the investor with any of the voting rights. If the company gets huge profit, then they won't get any sort of extra bonus. So advantages and disadvantages clear of both. Now, how the shares are issued? What is the process of sharing? Doing that. So first, what happens if you understand in a basic way? It's like prospectus means detail of a company and shares in prospectus. That's 90% of application is necessary. In advertisement, newspaper, you can see the advertisement. Even in a financial market, if you go, the scrolling will be coming up over there about the different companies who are in a way of processing to issue the shares. Over there, you can find the details of the company and the shares in prospectus. That's 90% is application. Now, if after prospectus comes out in application, where in the advertisement you can see that so and so company is going to issue the shares, and you can file up the application by this way. So means if access application received, the company issue shares by pro rata basis. Then comes out with the allotment. Full amount can be called up by the company at the time of application, or it can be paid up in installment also. So suppose if a company is issuing 1000 shares and you have applied for 1000, might not be possible you'll get 1000. You might get certain amount because huge number of people will be applying for that. And if a company thinks that okay, to one person it's okay, and the financial background of that person is also strong enough, it might be the possible. But mostly companies, when they issue the sale, they see that there should be the segregations of their risks, means defragmentations of their risk, defragmentations of the investors. Then comes repayment of dividend. Share of the company may be issued by any of the following steps: at par, at premium, and at discount. Means per share you will get this much, or it might be at the premium basis like 3 months, 6 months, 1 year, 5 year, 10 years, like this. That can be. And then comes the repayment of dividends, means issue of shares for consideration order the cash, might be issue of shares to vendors or to promoters. 30 features of shares, buying back of shares, right shares, redemptions of preference shares, and debentures. So certain process goes, and those are only four process: prospectus, application, allotment, and repayment, and dividend. Now, how basic earning per share is calculated? So the formula for that is net income minus preferred dividends divided by weighted average common shares outstanding. We'll understand this formula in our example also. So this is the basic earning per share calculation formula. Now over here, see in the example. Suppose if a company X has 1 lakh equity shares and 50,000 10% cumulative preference shares. So the company has reported a net profit after tax of rupees 5k for the year ended March 31st, 2014. Now, how much profit the company has earned? It says that profit is 5 lakhs, right? Outstanding equity means outstanding equity, actual equity share is 1 lakh, right? Now, it says that how much cumulative preference shares. So when it comes with the formula, basic EPS equals to net profit minus preferred dividend divided by number of equity shares. So when you divide 5 lakhs is the net profit minus preference dividend means 10% of 50,000. That comes out to be 5%. That comes out to be 5,000, and when you divide it with the number of equities, total whole number of equity shares, that is 1 lakh. So it comes out to be 4.95 rupees per share. Basic earning on a share, you are getting that much. Clear? And
Yes,
whenever you get buy a share, you get a share certificate, and those share certificate can be in a of any of that particular company on a different way. So the thing what will come in share certificate will be your name, for how much long you have taking it, or how the company has promised you, what is the amount of dividend or interest, or it's at par, it's at premium, it's at discounted, how it is, all the information will be there in your share certificate. So by showing that certificate, you turns out to be either an equity shareholders or preference shareholder. Now let's understand what is debenture. As I said that debenture are also like shares, but mostly debenture are long-term investment of the company on the company of a person. Like a debenture is a medium to long-term debt instrument used by large company to borrow money at a fixed rate of interest. A debenture is thus like a certificate of loan or a loan board evidence the fact that the company is liable to pay a special amount with interest, and although the money raised by the debenture becomes a part of the company capital structure, it does not become share capital. It becomes capital structure of the company.
ma'am.
So, yeah.
Ma'am, is it liability to the company?
Uh, it's not actually the liability of the company. It's like suppose let me give you an example of you might have heard that sometimes bank issue long term shares, right?
Yes.
It's like a fixed deposit way that you keep it for this much years and you are going to get fixed amount of this much interest, or your money amount which by which you are getting the shares might be doubled
It's
in
a type
fixed
of
amount.
bond.
Yeah, it's like a type of bond, exactly like promissory notes issued by companies, right? Not by companies but government authorities. Promissory notes, and a way of collecting fund from the market.
Okay, okay.
Clear? Okay,
Yes.
and types of debentures, like on the basis of security, redemptions, recognition, considerability, and priority. There are different forms of debentures, and company issues debentures on their priority basis, whether they are making it for uh, security, if that is security might be mortgage they are doing. If it is redeemable, it's like you can renew it time to time, or it's non-redeemable, it's regional, certificately, or it's just a normal one. It depends on company's requirement of say of the capital structure required for the company expansion or running to the company. So what are actually the advantages of the venture shareholders? So it's a fixed source of income. You're every month you're getting certain amount, a fixed amount, right? Safe investment for the person. And definite maturity period might be 2 years, 1 year, 5 year, 10 year, 15 years, or 20 years, right? By taking debentures of certain companies do not become a voting right to the companies, right? You creditors, not the owners. You people are creditors to the company, but not the owners of the company, right? Understood? Mostly when you can see when RBI issues promissory notes, many of the people try to invest, right? They take the certificate, debenture certificates, and which can be, you can say, used as a, what to say, used as a share capital structure. Means you can show it to the governments, or you can show it to the company auditors that you have invested this much amount, and it can be turned out in a liable, you can say, you can say it can be liquidated whenever it is required for you, easy liquidable to you, or easy liquidable to the investment person can be done. So fixed source of income, safe investment for longer period of time. Now, what are the basic difference of equity and preference shareholders? We have discussed it, but let's understand on a basis of differences, that is rate of dividend. Preference shareholders are paid dividend at a fixed rate, whereas in equity it can be changing and depending upon the available of profit to the organization. Areas of dividend. Holders of cumulative preference share can get the areas of past dividend, whereas equity shareholder cannot get the areas of past dividend. Redemptibility. Preference shareholders do not have the right to participate in any of the management team of the company, but equity shareholders can enjoy the voting rights. And even in any of the decision, they can play the role. And the payment of dividend are always done to the preference shareholders first, and then comes to the equity shareholders. Preference shareholders are convertible. They can convert it into equity shares anytime they want, or they can just sell it out to other person. But equity shareholders shares cannot be converted into preference shares. They remain to be equity shares, but they can be easily transferable or sell out to other person. Then comes the difference between shares and debenture. By understanding the difference, you'll understand so much about shares and debentures. If you see about the ownership, the shares of a company provides ownership to the shareholders. If you are taking equity shares, you become a owner of the company. But when it comes to the debentures, debenture holders provide loan, thus debenture holders are creditors of a company. Shareholders gets the return in form of dividend, debenture holders gets the return in the form of interest. Person holding share is known as shareholder. Person holding debenture is known as debenture holders. No certainty of return in case of loss in shares. Whereas in debenture, the rate of interest is fixed and is to be paid even if there is no profit. Repayment if the company liquidates and funds are available. Repayment during its lifetime or at the specified periods. Shares can be converted into debentures, but debentures cannot be converted into shares. Shareholders have the right to participate and vote in company meeting. Debenture holders, they do not have. Shareholders get the payments after the debenture holder gets. And that also, if after debenture comes out to be preference shareholders, when they get, then only equity shareholders gets it. Debenture holders get the first priority on payment. The dividend is not deducted from taxable, whereas the interest is deductible from taxable income. Now, when it comes with the shares, first, whenever the company is new, they try to say bring out the initial public offering, that is called as IPO. Means an initial public offering, an IPO is the first sale of stock by a company to the public. A company can raise money by issuing either debt or equity. If the company has never issued equity to the public, it's known as IPO. And IPOs are often issued by smaller, younger companies seeking capital to expand. So, whatever the company is, like if there is small or medium, let's understand if the company is entering into the financial market for the first time, right? In order to collect certain sum or fund or capital for their company, is called IPO. If you see the example of the IPO, they will be like in a way that is published in the newspaper or by the government medium, that certain companies are this company is sharing is issuing out the IPOs, initial public offering, and per share cost this much. You can take, one person can take 10 shares, or they limit to the shares also. So IPOs are always for in a way of by smaller and younger companies, like startup companies, they mostly prefer to go for the IPOs. Then when IPO is done, the same IPO is being followed again by the company. If it is followed by the same company, the next time is known as follow on public offer, that is FPO. An FPO is a process by which a company which is already listed on an exchange issues new share to the investor or the existing shareholders, usually the promoters. An FPO is used by companies to diversify their equity base. Suppose uh, a company which is just a new company has issued once, and after 6 month again they are issuing the shares, that is follow up on public offer, that is FPO, in order to collect certain fund and diversify the risk also. So FPO, any of the organization or the company can come, and the newspaper do publish in this way. You can see, if you go to the financial market column of the newspaper, you can see many of the companies are coming up with the IPOs or FPOs, and then coming out with the shares, and that also equity shares or preference shares. They clearly mention that, and if, then they are coming with the uh, redemption or non-redemption, or it's about as per premium, discount, transferable, how they are going to do that. That all is been published in the financial market newspaper. You can go through and you can see how the newspaper advertisement are given for IPO, FPO, shares, and debentures. So you can say that if you are new to the financial market, you're first beginning to the entering in the financial market, if you are thinking to invest, it should begin from IPO, initial public offering, because over a IPO you will have a lesser risk. Suppose if a person can get 10 and you applied for 10, you might not get 10, you can get 5, 4, 6, and you can keep a track of how the prices are increasing, and anytime you can sell it out back to the financial market. So this one is the safest for the person who is just beginning with the financial market. Till here, any confusion, any question
Ma'am,
to ask?
whose value should be higher in case of IPO and FPO?
See, IPO is like initial way of doing it, right? And FPO means you are again following the IPO's process. And
Ma'am,
you,
if you see the case of Paytm, ma'am, their IPO is higher but FPO is lower. Ma'am, is there fixed criteria? IPO should always be higher than FPO, or FPO be higher than IPO?
it's like IPO is always higher, because when those who have purchased IPO, right, they are getting higher amount of interest, and you are motivating the same purchased person who have taken IPO, or you are motivating them to go and follow again their another FPO. Got it?
So, ma'am, the people who are investing, ma'am, they are the equity shareholders or preference. I think here it will be equity shareholders.
Yes.
Okay, okay.
So thank you for today's session. See you again. Have a good day.
Thank you, ma'am.